Dear students, Sai Ram to you all. Welcome to this session under National Income Accounting. Today we are going to compare all the three methods of measuring national income. What are the three methods? The product method or value added method we have covered already, and the second one expenditure method, and the third one is the income method. And all these three methods gives us the same value of GDP. That's what we are going to prove it today. And you, as you all know, these are the three methods: product method or value added method, expenditure method, and the income method. Now, the product method we have seen, the value added method. What is the equation? The equation is, this is cross value added. GVA mean cross value added. This is capital GVA, already we have seen, because the value added is total up or summed up. That is what it is called, cross value added. Therefore, this is the equation for the cross value added or the national income by which method? Product method or value added method. Value added method. Because it is value added method, that is what it is called as cross value added, GVAI. You know that? Here GVAI mean GVA1, the firm 1 cross value added, firm 2 cross value added, plus firm 3 cross value added, up to how many firms? N firms. GVA up to N firms cross value added. Add up together. That is what we are writing. Summation of I is equal to 1 to N GVA I is equal to GDP or national income NI. I hope you understood. The second one is the expenditure method. We have seen this is the final aggregate consumption expenditure in the economy, investment expenditure, government expenditure, and the X minus M is the net export or the export by the contribution of the expenditure by foreign sector. And the income method, yesterday only we have studied wages for the factors of production, profit, interest for the factors of production, rent for the factors of production. These are the three methods. Now we are going to compare all these three methods and how it gives the same GDP. Here you can see the product method. I have already explained that it is given I to N summation GVI, cross value added. For the expenditure method, you know what is that? GDP is equal to C plus I plus G plus X minus M. And for the income method, you know W plus P plus IN interest plus R. And here, to prove this, all the three methods, we are going to take an example here about two firms, the firm A and firm B. What firm A does is, it produces cotton. It produces cotton and without any raw material, because they have all the land, own labor, everything. Therefore, they utilize these factors of production and produce cotton plant. Then what they do, after producing cotton, they sell the cotton to the firm B. Therefore, the cotton produce worth of cotton rupees 50, firm A sells cotton to firm B. Therefore, you know firm B, it is a textile firm, textile industry or textile production they are involving. And what they will do, they will convert this 50 rupees worth of cotton to cloth. Therefore, what is happening is value added here. The cotton is converted or transformed. Cotton is the input or the intermediate good as far as the textile industry is concerned. This firm is concerned, firm B is concerned. That they are transforming through the production process cotton into cloth. Cotton into cloth. What is happening here? Value added. Value added. That is what it is called, value added method. And firm B sells the cloth produced To whom the final product is what here? Cloth. It is sold to the consumers for 200. Here we are going to see how to calculate the value added by firm A and value added by firm B. What is the value added? We have already studied value added under product method or value added method. It is nothing but sales minus intermediate goods. Therefore, what is the sale here? As a firm is concerned, value firm A is a farmer producing cotton. For him, sale is what? Rupees 50 he produced, and he is selling that same to firm B. But what is the intermediate goods he used? We assumed that there were no raw materials used by firm A. Therefore, this intermediate goods value is 0. Therefore, sales minus intermediate goods is coming rupees 50. Rupees 50. For value added by firm B is how much? We have seen firm B take the cotton and convert into cloth finally, and their sale is value of sales of cloth is 200, and value of intermediate goods they used is 50, because they purchased 50 rupees worth of cotton from farmer. Therefore, 200 is the sales, cloth sales for the consumers, minus intermediate good value 50. Therefore, value added is 150. Therefore, what is the total value added? Here two firms are there. Therefore, value added for this economy consisting of two firm A and firm B, firm A farmer, firm B textile owner or industry. What is that? Value added of A plus value added of B, firm B. What is value added of firm A? 50. What is the value added of firm B? 150. Therefore, total value added is 200. Therefore, value added is nothing but what? The GDP of this economy. GDP of this economy. GDP is find out using the value added method. That is called, that is the way we are finding. Therefore, GDP of this simple economy consisting of two firms is value added of firm A, value added of firm B. That's how you have to read. Value added of firm B. Firm B. This is value added of firm A. Firm A. You will get rupees 200. That is called GDP. Therefore, value added is the exact amount of GDP for this economy is 200. Now, at the same thing, we are representing this value added. This question used to be asked. Then you have to take this example and you have to express that values in the form of a tabulation. This is a table. You have to express it in your textbook. You have to put it in the form of a table. And here what is expressed here in this table? The information. What is the sales of firm A? 50. Sales of firm B? 200. And intermediate goods used by firm A? 0. Intermediate goods used by firm B? 50. Therefore, what is value added of firm A? Value added firm A is equal to 50. Here firm B, here the column is value added. Therefore, value added of firm B is 150. Therefore, you can say that GDP is equal to, again, value added of firm A plus value added of firm B. It is equal to 50 plus 150, 200. That is the GDP. I hope you understood. And now we are going to see the second method. Therefore, we have proved that GDP in our example 200 rupees using value added method. Now we are going to see how much for the same example GDP by expenditure method. But we are going to prove all the three methods gives us same value of GDP. Therefore, value added method, we have proved that in that particular example the GDP is 200. Now we are going to use the same example to calculate GDP using expenditure method. Expenditure method also, in other words, called as disposition methods. When you sell it, how much you are getting? that items, that is called expenditure, or we can say disposition method. GDP is equal to sum of final expenditure. Why we are telling final expenditure? Sum mean you are adding all the expenditures. We have seen what GDP is nothing but C plus I plus G plus X minus M. We are summing consumption expenditures, government expenditures and net export expenditure. That is what it is called summation. Why it is called final expenditure? Why we call it as final? It is only take the consideration of final goods, not intermediate goods. Therefore, expenditure on final goods. That is what it is called as final expenditure, not on intermediate goods, or expenditure on goods and services only for end use. End use means it is final goods, not intermediate goods. I hope you understood. Therefore, GDP by expenditure method is nothing but sum of final expenditure. That is what we wrote, summation of C plus I plus, GDP is equal to C plus I plus G plus X minus M. This C is what? Summation of all the consumption expenditures. I is equal to 1 to N. I is equal to what? I hope you recall all your last class session where I explained it is I is equal to 1 to N firm mean what we will do? II, all the firms will be added together. Like that, GI, summation of all the firm from I to 1 to N. Like that that will be equal to capital C. This all the addition will be equal to capital I. All that addition of GI is equal to capital G. That's how we finally proved GDP is equal to capital C plus capital I plus capital G plus X minus M. Now, in the above example, final expenditure is how much? In our example, we know the final end use was what? Cloth in our example. How much it was sold? For 200 rupees. It was purchased by consumers. It was purchased by consumers for 200 rupees. Therefore, the final end use of that production is sold for the 200 rupees. Therefore, the GDP is what? Rupees 200 in this way of expenditure method while measuring, because the end product is our cloth. The end product cloth gave us rupees 200. Therefore, expenditure by the consumers is how much? 200. Therefore, here only we don't have I, only one expenditure is there. No I, no G, no X minus M is there here. Therefore, GDP is equal to C plus I plus G plus X minus M. Here we don't have investment by private companies, government sector is not there, net export and import is not there. Only we have consumption expenditure. Therefore, GDP is equal to straight away C. What is a C? Cloth was consumed by consumers. That is what we say C is equal to 200. Therefore, here the consumption expenditure is 200. Therefore, GDP is 200. You recall that our value added method also, the G total value added is 200. Here expenditure method also GDP is 200. Now, we will go to the GDP in the case of distribution. This is the distribution or income method. Why say distribution? Whatever income received, we studied household, other side firm in our circular flow income. Household gives what? Factors of production. Factors of production. What are the factors of production? Land, labor, capital, entrepreneurship. What they do, this household there, but the firm does. Firm, all the income earned by the firm is distributed back as factor payment. Factor payment. Firm distribute as factor payment for the services of factors of production. Therefore, what are the factor payment? Wages, rent, interest and profit. These are the factor payments. Therefore, distribution, why we say distribution, income method or distribution method? Because whatever earned, whatever earned by, by the firm, whatever earned from the household, what is the earning? Spending. Spending is of the household is earning for the income for the firm. Whatever earned from the household again, because they will sell, they will utilize all the good factors of production and they will produce goods and services. When they sell goods and services back to household will spend to the firm. The spending of the firm is what? Of the household is what? Revenue to the firm. Therefore, whatever income earned by the firm again redistributed to the household back again in the form of, what is that? Land, rent, labor, wage, capital, interest and entrepreneurship as profit. That is what it is called. Whatever earned from household, firm is again distributing back to the household in the form of factor payment. That is what it is called, distribution method or income method. I think you have clearly understood. And now, out here what we are going to see is, we are going to assume that firm A earned rupees 50. That means received means firm A earned rupees 50. Out of this rupees 50, distribution, firm earned already firm A, this is the firm A, it is income is rupees 50. Out of this rupees 50, it is going to distribute back again to the household as wages rupees 20, and as profit rupees 30. Wages, and they keep but they are keeping for themselves. Profit is not because this is the firm A, firm A keeps the profit for them 30. And firm B, we assume firm B, it has rupees 150 received. The income is rupees 150 of the firm B. What they are going to do, there is two factors of production, factor payments are there, only wages and profit we assume. Here that out of 150, B keeps rupees 60 as wages firm B and rupees 90 they keep for them as profit. That is, this is a firm contribute, firm has to take for their factor contribution as entrepreneurship. Therefore, firm B keep 90. Therefore, this is the distribution pattern of firm A and the firm B. What is the distribution? Out of earned rupees 50, 20 is given as wages and 30 is given as profit. And for them only they are giving, but we are selling, they are given. And rupees 150, rupees 50 given as 60 given as wages out of 150 and 90 given as profit. But what is the income method? Income method GDP is what? W plus rent plus interest plus profit. In this economy, whatever firm A and firm B, when we consider, only wages there, no rent we are paying, no interest we are paying, only W plus P. The two factors, it's a simple economy, we are just example. Therefore, our GDP here we can calculate by W plus P. Only these two things are we have to consider. Therefore, I hope you understood. And that same thing I can express, same data of that sum we can express in the form of a table. Wages of firm A, how much? Rupees 20. Wages of firm B, rupees 60. Therefore, and if we take firm A alone, you can see firm A allotted out of 50 rupees earned, their income is rupees 50. Out of rupees 50, it has allotted to 20 as wages and profit, 30 as profit. And for out of 150 of firm B, it has given wages 60, wages row, and profit P is. Therefore, what we can do now? To act for firm A, what is GDP of firm A, 30 plus 20, 50, because W plus firm A, W plus B, P profit, that is 20 plus 30. Or we can see here, GDP by income method is nothing but sum total of factor incomes. For wages, how much wages firm A? 20. What is the profit firm A? 30. What is the sum total of factor income? What is the wages for firm B? 60. Profit 90. That is the factors of factor income earned or distributed among the wages and profit. Now we will see GDP income method is nothing but sum total of factor income. What are the factor income? Wages and profit is here. Only two factor income we are considering. And GDP, total wages received by workers of A and B. How much workers of A is received? We have seen workers of A and B, and the total profit earned by workers of firm A and workers of firm B. Therefore, we know wages by firm A 20, wages earned by firm B workers 60, and profit earned by firm A workers 30, and profit earned by firm B workers 90. Therefore, how much? 80 plus 120. Again we are deriving 200 as GDP, because GDP income method is nothing but sum total of factor income. Here what are the factors? Factor income? Wages plus profit. Wages plus profit. We have to see wages of both the firm A and firm B, as well as profit of firm A and profit of firm B. The wages of firm A 20 plus 20. Wages of firm B worker 60. Profit of firm A 30. Profit of firm B 90. Therefore, you add 200. Therefore, what is the conclusion we can make out of these methods? We can make that all the three methods results in same value of GDP. Therefore, this is the explanation for that same concept. GDP C plus I plus G plus X minus M. What is this method? Expenditure method. Income method W plus R plus IN plus P. This all will be plus 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 plus. This method, income method. And this one, cross value added. It is what method? Product method. Cross value added. All that GDP in this example is equal to rupees 200. That is what it is explained here. It's not necessary to put plus, you know, it is automatically plus only. Therefore, GDP, all the three methods gives us same amount of GDP. This is the amount of GDP is same is given by all the three methods. And product method, according to our calculation from the previous slides, GDP is equal to this, and which is equal to 200. And expenditure method also we have proved the consumption expenditure only there, that was 200. And then income method also we have seen the factor payment only was wages and profit, and it is again by 200. Therefore, what we can conclude, all the three methods are giving, all the three methods estimating GDP, methods of estimating GDP give us the same answer. That is, whether this method, value added method, or this method, expenditure method, or this method, income method, is give us rupees 200. Therefore, what we can, this question, after this question is very important, because exactly this question is being asked again and again in the board exam. Explain a numerical example. That is the example we have taken. Farmers 50 rupees production of cotton, and the textile people convert the 50 rupees cotton into 200 worth of clothes. The same numerical example you can use to show that all the three methods of estimating GDP give us the same answer, to rupees 200. I hope you have understood, and you can go through these slides again and write the answer for this. And again, I want to quote some quotations from Bhagavan Sri Sathya Sai Baba. Doing your duty efficiently is yoga. What is yoga? You do your duty as perfect as possible. The reason is God is perfect. Therefore, your duty also should be perfect. It is the dharma of a student or a teacher or anybody who is involving any type of work. Therefore, as a student, time waste is life waste. Whatever you are studying with clarity, again you can teach back to your students with a clarity. Therefore, do your duty efficiently. That is, dharma is allotted to you. Sanctify all actions by dedicating them to God. Whatever the form of God you worship, you dedicate all your actions from the heart and the soul, and thereby you will get the grace of God. It will protect you whenever you are in need. And happiness is nothing but union with God, because all the worldly happiness are temporary. One day it will vanish. Only happiness, union with God, is eternal. It will give you the permanent happiness, that is bliss. Sai Ram, Bhagavan Sri Sathya Sai Baba. And thank you all. Sai Ram.